Good day friends, welcome to the lecture series on fundamental of investment. In the subject of fundamental of investment, we were discussing the topic of mutual fund. In my previous lectures, the 4 lectures which I delivered on the mutual fund, I talked about what is mutual fund and what are the benefits of investing through mutual funds. If you invest directly instead of routing through the mutual funds, what can be the limitations, what are the different schemes, what is the structure of the mutual fund, and we talked in detail. Almost 2 lectures we devoted on different schemes of the mutual fund, and this was the point of discussion. Today I'll take my lecture forward and I'll talk of certain specific aspects about the mutual funds. Friends, as I said in the initial lecture on the mutual fund, Demystifying Mutual Fund Landscape, the mutual fund industry in India is growing at a very fast rate. Almost 37 to 38 lakh crore rupees is being invested in the mutual fund industry. Today, there are more than 12 crore accounts, that is folios, which are being handled by the mutual fund industry. So this industry is expanding at a very fast rate. When I say mutual fund industry, it means people in India are investing through mutual funds. So I will be talking certain specific aspects about the mutual fund. One aspect is investing through systematic investment plan. Friends, today the systematic investment plan is becoming very popular in India. You can gauge this popularity by the figures which I am going to give you, that almost 12,000 crore rupees in a country like India, which we cannot say is a developed country, it is a developing country. The income level is not very high in India. Average income in India is not very high. Even in that economy where the people's savings is not very high, I am talking of the total population. Even in this scenario, almost 12,000 crore rupees is coming every month through SIP. And what is this SIP? Means the systematic investment plan is a planned way of investing in which investor invests a fixed sum of money at regular intervals. It may be a month, it may be a quarter, it may be depending on the time interval which you prescribe, which you give to your asset management company or the mutual fund. During that intervals, or means at that intervals, your investment, your amount will be invested by the mutual fund. So SIP, systematic investment plan, is popularly known as SIP, is a method of investing a fixed sum regularly in a mutual fund scheme. SIP allows one to buy units on a given date each month or a quarter, so that one can implement a saving plan for oneself. So as I was saying, that 12,000 crore rupees almost is coming through SIP every month in India, and there are almost more than 5 crore accounts, folios, under which the SIP investment is taking place. So under different schemes, 5 crore people, I can say, it is not necessarily one person may be investing in 4 different schemes, but that will be considered as a different account. Means 5,000 different accounts, 5 crore different accounts, the investment is coming in the SIP. So what the individual do in this is that a fixed sum of money, say 5,000 rupees per month or 10,000 rupees per month, depending on your investing capacity and depending on your choice, a fixed sum of money is being invested in a particular scheme, right? So at a fixed date, means when you apply for investment through SIP, you fix a date that every month from my account, this much sum of money on this date can be withdrawn and transferred to the SIP amount, transferred to the mutual fund account. So investing every month will ensure that one is invested at the high and low and make the best out of an opportunity that could be tough to predict in advance. Friends, this is the basic beauty, I would say, of the SIP, systematic investment plan, that you enjoy the benefit of highs and lows of the market. I would say that investing in the stock market, investing in the market through, when I say investing in the market means I am talking of the shares, stocks or the debt, is also a psychological game. Normally the tendency of the people is, this is not only in India, throughout the world, then when market goes up, people think that it will go up further, and market comes down, people think that it will come down further. So it is very difficult for an individual to time the market. When I am saying time the market means when to invest, what is the right time to invest. It is very, very difficult. If I use the word, almost it is impossible for a common man to time the market, that which is the right time to invest is a really a challenging job. So what you do in the SIP account is that without thinking what time, at what intervals should I invest, intervals means when should I invest, you allow the mutual fund industry, you allow the mutual fund scheme to invest at regular intervals, so that even if the market is high, you will be investing in that time. When the market is low, even at that time you are investing. To give you an example, see, when the COVID-19 came in the world, all the stock markets of the world tumbled, means it falls drastically. And throughout the world, there was a lockdown. Almost in every country, there was a lockdown. So the stock market, the market was crashing, means it came down significantly. At that point of time, people who had not invested through SIP, they did not stop, or only a very small section of the society or a very small amount was being invested at that time. Those people who were investing through SIP and they did not stop their SIP at that point of time, they enjoyed the benefit of investing at the lower point of the market. What it means is that instead of taking the individual decisions, the decision has been taken in the past that at regular intervals you are enjoying, you have to invest. So even if the market comes down, even at that time your investment is taking place. So you are investing at all time, at all different point of time of the market. Whether market is high, whether market is low, it is immaterial. So you will able to get the benefit of averaging. So the amount is invested at the closing net asset value of a given date. So suppose today my date of investing is, so whatever the closing price of the net, I will be discussing in detail about the net asset value. At that price, in that scheme, the investment will take place. Through these figures, what I have tried to show, that how through SIP that you can increase your investment, or you can get the benefit of investing through SIP. I am presuming, supposing you are making an investment of 5,000 rupees, and if the rate of return, rate of interest means rate of return, you are expecting is 7%. So if you regularly invest this 5,000 rupees for 5 years, you will be getting at the end of the 5 years, means what will be your investment? 60,000 rupees per annum. That comes to be 3 lakh rupees in 5 years. And I am presuming a very moderate return of 7%, the amount you will be getting will be 3,60,000 in odd figure. And if this amount is being invested for 25 years regularly, this amount will become 40,73,986. So friends, 5,000 rupees per month for a middle class person is not a big amount. But if you regularly and invest in a disciplined manner, if you start investing when you start earning, that is in the age of 24, 25, by the time you will become 50, you will be able to get 40,70,000 rupees, 986 rupees. So you can imagine. But normally it has been observed in India that in the long run, the rate of return is more than 7%, is 11%, 12%, sometimes 15%. So even if you take 11% interest and you invest, interest means you are presuming that you will be investing 5,000 rupees for a X number of years, and if the rate of return on your investment is 11%, friends, again I would reiterate that 11% return in the stock market is not a very high return. I am presuming, to be conservative, I am presuming if the return is 11%, despite of that, 5,000 rupees worth of investing for 25 years will become 79,52,906 amount. So you will have a large sum of money if you invest 5,000 rupees money per month, and and return is 11%. If you invest this money for 15 years, the amount will be 22,94,821. What it means is that if you make systematic investment, you will have a large corpus at your disposal after a period of time. So this is the beauty of investing through SIP. So, supposing normally many people say, I want this much sum of money after this much number of years, right? And for that also you can plan that supposing I want to have a 60 lakh rupees after 15 years for the education of my child, right? And I'm presuming a very conservative rate of return of 8%. So what should be the SIP amount? It will be 17,300. These days, friends, there are automatic calculators. You just put the figures. They will give you the figures that how much amount is to be invested on a monthly basis, so that you can have that much sum of money after this much number of years, right? This is just a broad example to make you understand that you can get an amount of investment, a particular amount of investment, by investing a SIP amount of this much sum of money. Means if you invest 17,300 rupees per month, right, for 15 years, you will get 60 lakh rupees, right? So in this way you can plan your future expenses. So now comes what are the benefits of SIP. This is very important to understand. As I've been discussing with you the benefits in the course of my discussion on SIP. Rupee cost averaging. When I say rupee cost averaging, means that you get average. When I was saying you are investing at the top of the market, you are investing at the bottom of the market, you are investing at in all times because market never remains static. When I say market, means stock market. Stock market never remains static. Sometime, if I talk of India, sometime the Sensex is high, which is the index number of the Bombay Stock Exchange, BSE, and sometime the market is low. Means, so you are investing at the low of the market, you are investing at the high of the market. So what you get is average of your investment. So it's called rupee cost averaging. The other benefit is power of compounding. Friends, this is very, very important, I would say, feature of any investment. And this is, I would say, a mantra of investing. Power of compounding. The longer you invest, the better money you will get, the larger you will get. So, and as a human being, we have average life, means say 75 years. The early you start investing, and especially for your retirement planning, for your long-term expenses, you want to buy a big house in a big city like Delhi, say metropolitan city like Mumbai, right? You want to buy a big house, so you want to have a 5 crore rupees after this much number of years, right? So you start investing early. The moment you start earning, say in the age of 24, 25, you start investing. By the time you will become 50, 55, you will have a large sum of money, right? So power of compounding, and through SIP, you can get the benefit of power of compounding. Because practically what happens in the SIP is that you just invest and forget. When you invest and forget, your money keep on increasing slowly and gradually over a period of time, right? So say whatever your income level, I'm presuming your income level is say 2 lakh rupees per month. And out of that, if you invest 10,000 rupees, it will not affect much of your expenditure. Means it is just going, you will not feel the pinch of issuing a check of rupees 10,000. And mind it, every month you don't have to issue the check, right? You just give instruction to your bank, you just give instruction to the scheme in which you have invested, that you fill a form, and this form will allow the mutual fund company to withdraw the 10,000 rupees per month or per quarter, whatever the instructions may be, from your bank account. Automatically the figures will be debited from your bank and will be credited to the mutual fund house, right? So it means under your scheme. And in long period of time, say after 10 years, 15 years, 20 years, whatever your time horizon is, it will be grow a big sum of money. So this is called a power of compounding. This is a very, very important mantra of investment. So through SIP, you get the benefit of compounding. Disciplined savings. As I was referring to while I was talking of power of compounding, that whatever the income level you have, out of this, if you have already given the instruction to the bank or to the mutual fund that this money should be invested in the mutual fund on this date. So what you are doing is there is a disciplined saving you are doing. In investment, we always suggest first plan your saving, then plan your expenditure. That is, whatever your income level is, say one's income level is 1 lakh rupees per month. So you decide that 15% of it you will save. Minimally 15% of it you will save. So first make the savings of 15,000 rupees. And then remaining 85,000 rupees you should plan for your expenditure. Right? So this is the disciplined savings. And when you invest through savings, SIP, you learn to have a disciplined saving. Because automatically the bank will deduct 10,000 rupees or 15,000 rupees from your bank and it will be invested in the mutual fund. So it is a disciplined savings. Flexibility. Under the SIP, there is a flexible element also. I'll be talking this point later on also. In the sense, you can increase the amount of contribution, you can decrease the amount of contribution. There is a flexibility. I'm investing 10,000 rupees per month. After some time, I feel that I should increase this investment from 10,000 to 12,000 rupees. I can just give the instruction to my mutual fund house or the scheme under which I have invested. I will give the instruction to the mutual fund, right, that this SIP should be increased from 10,000 to 12,000 rupees, right? So it can be expanded, or vice versa also. Because I have some larger expenses in hand. I want that for a 1 year period, I would not able to make a SIP of 10,000 rupees. I want to make a SIP of only 5,000 rupees. You just give instruction in writing to the mutual fund that this SIP amount should be reduced to 5,000 rupees. They will do it. So there is a flexibility, right? So the SIP provides you the benefit of flexibility, long-term gains, right? We always advise, we always suggest that investing in the share market, stock market, or investing through shares is a long-term gain. And in India, that if you invest for more than a year, you get the benefit of long-term gains, means capital gains I am talking of. If you invest for less than a year, you get a short-term capital gain. And tax rate in long-term and short-term is different. So if you invest in long-term, you will be getting the benefit of long-term gains, plus whatever the long-term capital gains, plus investing in long time, as I was saying in the power of compounding, you always tends to get the benefit of long-term, right? Convenience. It is very convenient. Every month you don't have to issue the check, you don't have to do anything. You just fill a form, attach a check, right? Cancel check, give instruction to your bank or give instruction to the mutual fund or give permission to the mutual fund to deduct this much sum of money from a bank. Automatically the money will be deducted from a bank and will be transferred to the scheme in which you have invested. Plus, anytime, whenever you want to withdraw this money, like supposing I have been investing for the last 4 years, 5 years, now I want to take this money back. You just fill a form, within 2-3 days, your money will be back. So it is a very convenient. These days in the online system, you just put a mail or put their withdrawal form that you want to withdraw from this scheme, you want to stop your SIP and want to withdraw. You just, by the click of the mouse, I can say, you can withdraw the money. So it's very convenient. So this is the benefits of investing through SIP. As you can see in this photo, this tree will grow and keep on growing. This investment will keep on growing as the time goes on, right? So now I'll be talking in brief about the type of SIPs. One is called top-up SIPs. Top-up SIPs means, as I was saying, there is a flexibility. One of the benefit of the SIP investment is, through SIP investment is that flexibility is there. You can invest at a fixed intervals and you feel that every month, every year, your income increases. So you start with, say, in this example, 10,000 rupees. And I can give instruction to the mutual fund or to the manager who is managing the scheme that every year 1,000 rupees my SIP amount may be increased, right? Or after 6 months 1,000 rupees can be increased. Whatever the instruction you will give. So this is called top up. I started with 10,000 rupees, then I say after 6 months it can be increased to 11,000 rupees. After 12 months it will be increased to 12,000 rupees. After 18 months it will be increased to 13,000 rupees per month. Like that. This is called top up SIP. Top up SIP means as your income grows or you feel that your income will grow, you will give just at the initial level itself that after a fixed interval, say after a year or after 6 months, whatever the time you decide, after every year your SIP amount may be increased by this much sum of money. You can top up. Top up means increasing the SIP amount. Flexible SIP. See, it allows the investor to adjust the SIP amount based on his financial condition as well as condition of the market. When you feel that the market has topped, market is topping. When I am saying market is topping means market is very high, market is booming. You are fearful that tomorrow, or means when I use the word tomorrow means after some time the stock market may fail, right? May fall. So you can reduce the SIP amount or you can stop the SIP amount. Or when you feel that the stock market is at its bottom, it's low, market is expected to grow in the future, right? Today it is low, means when I use the word today in the stock market, today when I am saying is at present, the market is low, you tends to increase your SIP amount, right? So you feel that after 3 years, after 2 years, as the market will expand, as the market will boom, right? So your investment will increase at a high rate. Right. So there is a flexible SIP. Means what it means is the SIP amount can be increased or decreased as per your instructions, as per your requirements, as per your wishes. Perpetual SIP. Perpetual SIP means SIP we may be doing for a fixed period of time, 2 years, 3 years, 5 years, 10 years, or you fill a form that perpetual means continuous basis. That let this SIP amount be continue forever, or up to the time when you give instruction, when you stop it. So such SIP to continue unless the investor give specific instruction to stop them. That till the time I give the instruction to you to stop my SIP, let this SIP be continued, right? So supposing you start investing at the time when you start earning, I'm presuming you start earning in the age of 25, right? So you give instruction that this SIP amount is a perpetual. Up till the time you do not stop it, it will continue, right? So this is called perpetual SIP. Trigger SIP. This is also very important. With the trigger SIP, investor sets a trigger for his SIP investment. What is this trigger? For instance, one can mention that SIP amount should be withdrawn from the bank account and used to purchase units of the selected scheme only if the NAV of the scheme falls up to a certain level decided by the investor. See, every mutual fund scheme has a net asset value, which you call it NAV, which I'll be talking in detail today, right? So every unit has a NAV. You give instruction that you instruct your mutual manager that in this scheme your investment will be made at that point of time when NAV of the scheme, NAV of the unit reaches at this level. Means normally people give the instruction when the NAV falls, right? It is the right time to invest in the mutual fund or in that scheme. So you give the instruction when NAV falls by this much or NAV comes to this level, your investment should be made. This is called trigger SIP. So a triggered bells starts that this much at this price your investment should be made. Now friends, after talking of the systematic investment plan, I will now speak of the systematic withdrawal plan. The way you invest at a regular interval, similarly you can withdraw your money at regular intervals, right? When I was referring about SIP, time and again you start investing in 25 years and you want to make investment up to the age of 50. So when you're investing up to the age of 50, after that, or let me take it up to 60, you are going to retire in the age of 60, right? So from 25 up to 60, or at any age you started investing in 45, 50 year and you invest up to 60. And then once you retire, you need money. For that time, or means you will feel that in that age you will not be in a capacity to earn, you take a systematic withdrawal plan that every month this much money, or every quarter or every year, whatever your time interval may be, right, you will withdraw this much money from that scheme where you had invested earlier, right? Or I'm investing a lump sum money, say for example 50 lakh rupees, right? I invest 50 lakh rupees, and this 50 lakh rupees will be invested by the mutual fund manager, right, in a mutual fund scheme. And with this investment, they will make investment, and I'm expecting my investment will grow, it will earn income. And with this income and my investment, every month or every quarter, I'll withdraw a fixed sum of money, means every month or every quarter, as per the requirement of the investor, the money will be transferred to my bank account. You may ask why this is planned. Because 50 lakh rupees which I am investing, it will be invested by the mutual fund manager. It will be invested in a mutual fund scheme, and I am assuming that scheme, this money which I am investing in the mutual fund will grow. It will earn income, right? My investment will grow. With this growth, I'll get some regular income, right? And which I can withdraw partly of this my income, or my income which is being generated plus my initial amount can be withdrawn after a regular interval. So systematic withdrawal plan provides the investor with a regular income and returns on the money that is still invested in the scheme. Money remains invested, but partly part of the money I withdraw every month, right? So for example, an investor has 10,000 units in a mutual fund scheme. He has given instruction to the fund house that he wants to withdraw 5,000 every month through systematic withdrawal plan. SWP means systematic withdrawal plan, right? So on January 1, 19, the NAV of the scheme is 10. So equivalent number of mutual fund units is 5,000 divided by 10, that comes to be 500. So my 500 units will be redeemed. Means it will be given back to me. Remaining is 9,500 units. So next month I'll be withdrawing this 9,500 or 500 units multiplied by NAV value. That amount will be withdrawn from me. So this is a regular feature that can be done. So systematic withdrawal plan is normally been taken by the people who wants a regular income from the mutual funds. So friends, this is for this lecture. I have talked about systematic investment plan and systematic withdrawal plan. I'll be talking in the next lecture also about the mutual fund. Right? Thank you.